Good morning. How you doing? It is the 0DTE morning market analysis, and I'm Coach Ernie. And today we're going to take a look at, as we do every morning, what our market situation is. Situational analysis to determine three things. We want to determine how much exposure we have to the current level of volatility, so that will determine the width of our out-of-the-money butterfly. We want to determine what direction that we're going in, and that will actually be the topic of discussion today. And we want to find out where is our entry event, and that is determined by market structure, structural levels, determined by volume profile. Those three things. And as I said, our focus today is how do we determine in turmoil markets that seem to be going sideways, which way do we trade? We have to pick a way, right? All right. So that will be the focus. Let's get to it. We're going to look at the VIX first. Hold on. I've got to choose the trading view. There we go. All right. As we do every morning, we're determining our width, how much we want to expose ourselves to the current level of volatility, the rate of decay of premium, and that is ultimately determined by how much energy there is in the market. And the energy is waning. It is starting to seep out. You can see we are a little bit lower than we were yesterday. We're out of the Goldilocks zone now at 15.86. That means if we go over here over to the left, you can see that our width range is between 15 and 25. We hone in on that by looking at what I used to call the poor man's straddle, but it's essentially an at-the-money butterfly, very wide. We look at the debit of that. That gives us a really good indication of what the market is pricing in terms of optionality. And so we'll take a look at that next to see. Here's the other guide up top. See the big ass fly, debit butterfly width gauge. It tells us which side of that width to be on. It's also a trade, an edge case trade. If the debit is under 25, then we choose to take that big ass fly. But right now, we're just going to use it as an indicator. All right. So let's do that. Need to go to. Sorry. Takes a little while to see where I'm going. Think or swim. There we go. All right. So I have the big ass fly all set up. It's a 50 wide fly at the money. The price of it right now is above 25 at 26.30. So there's no trade on this morning for the big ass fly. We've been doing it quite a bit, which is unusual, especially with lower VIX readings recently. So, but today, definitely not. The market has started to find a new leg up, and that's going to be, again, something that we'll talk about. So we come back to the VIX and our trading guide, and we can see that something in the 26 range should be somewhere between 15 and 20. All right? So that's your poison. You pick 15 or 20 wide. Let's say 20 wide. I tend to round up and go to the next higher width. That's what I do. And so we'll be looking for a 20 wide out of the money fly. Next thing is to look at direction. And as I said, that will be the topic of discussion today. And right now our directional bias is bullish, all right, because we are above the moving average. Next step is to look at market structure. But before we do, let's look at the big picture where we are on the volume profile. We are inside of this, what I would call a minor node. This might be called a major node, parent, child, that sort of type of thing. And there's another node above us, and we have a small volume well above us as well. So you can see what we're looking for are structural levels, and that's in these really deep crevices inside of the LVNs, or what I call volume wells, or on the edges where there's a strong change in the demarcation between high volume and low volume. Those all provide significant levels of support and resistance. So what we do then is we mark this up and find out where all those edges are. I use a color coding and weight scheme to figure out where the edges of the nodes are, because the behavior between nodes and volume wells is very different. Volume wells, because there's lower liquidity, price tends to move a lot faster. That's where markets tend to trend, or they're looking for value. And the nodes themselves is much higher liquidity. That's where the market has found value, and markets tend to move a little bit more stable, I guess you could say. And currently we're right at the very top of this high volume node, looking to punch into this volume well. And we are on a 3-day, 3-day bullish move, even though the previous 3 days we were bearish. Our directional moves were bearish. And even though we were bearish in choosing a put fly, we still were able to eke out profit, either from the big ass fly or a temporary move that went in our direction and then reversed, and we got out, but we got out with small profits. So it's interesting that even though you pick a market direction and you're wrong ultimately for the day, you can still be right in terms of profitability. So that's a key point that I want you to keep in mind. So let's zoom in on this and see what this looks like on the day level. And you can clearly see, well, maybe not clearly, but pretty clear, the green line here and the red line here are denoting the bottom and top of that big volume node, that high value node. And we've already bumped up to the top of it and found it as resistance twice here. It looks like we're going to give it another shot and move up. These other blue lines are, I guess you could call them crevices inside the node. They are places where volume has been depleted, and they provide, again, other structural levels interior to the node. And you can see how the market has respected those as well. So it looks like we're going to make another run up here and then move up into that volume well that's above. We'll see. Is 3 times a charm? I don't know. But our general strategy is to, when we're in an uptrend, is to look for pullbacks into structural levels. So we'll be looking for a pullback there, and then of course at the bottom of this. So we're looking for something like this. Move down into here, and if we determine that it is finding support there, then we take a out of the money butterfly, in this case a call fly, up here somewhere. All right. And how do we determine where that goes? Well, we already know the width. We know that all of our flies are going to be asymmetric. We start at about a 10% debit, which gives us about a 1-to-9 risk to reward ratio. But we have some flexibility. We can go anywhere from about 1-to-7 to 1-to-12, and depending on what the pricing is of the fly. And so that's how we choose the width. So, and then we have direction. And so we wait for the event, the width, the direction. We have everything we need. All right. Now, how is it that we choose direction? We've got to talk about this a bit. There are a number of ways that you can choose direction, and essentially our method is to trade with the trend. But what do you do when the trend isn't really strong or discernible, as has been the case for, well, geez, since November? You can see that we've been just all over the place and a lot of just churning back and forth. I mean, most of this looks like noise. I mean, there has been a few good stretches where we've moved, confidently, and those were good and everything. But you look at these last 3 days here, they all started below the moving average, and we were kind of turning over, but they all reversed. And as I said, on all of those days, we had opportunities to profit, even though we were going for a put fly and the ultimate move was bullish. So that's an important part. Now, generally, the way I look at this is that most analysts will say that consistent market moves in one direction or the other that last, say, 2 to 3 weeks, maybe 4 weeks. Maybe some people need 4 weeks. I don't know why. But 2 to 3 weeks is about the average. So we what we do is we look at a relatively fast moving average. I use the Hull moving average on a 21-day period. And there are two ways that you can read this. If price is above the moving average, then we're bullish. If it's below the moving average, then we're bearish. Now, another way you could read it is you could look strictly at the slope of the moving average. So in other words, here on the Hull, it's colored purple when the slope is down, and it's colored blue when the slope is up. So if the slope is up, then you go bullish. If the slope is down, then you go bearish. So those are two different ways. They have their pluses and minuses. Both will ultimately give you about the same result. You see, the market is a coin flip, essentially, on any given day. You don't believe me? Oh my God, you don't believe me. You don't believe that the market is a coin flip on any given day, regardless of the trend. Well, I'm going to show you something otherwise. And the first thing I need to do is go to, where is it? There it is, Microsoft Excel. And this, I got to make sure I have the right thing here. Yeah. All right. So what I'm showing here is a distribution of daily prices on the S&P 500 since the year 2000. And this red line right in the middle here is a 0% move. And so moves to the right are positive moves, and moves to the left are negative moves or down moves. And then, of course, the y-axis is showing us the frequency of those sized moves. Now, the first thing you'll notice is that, well, if that red line is a zero line, you can see obviously that a 0% move is one of the most frequently encountered moves in the market, which is crazy, right? But if you also then peer at this, and it becomes very obvious that we have about an equal distribution of moves that go to the right and to the left, meaning that on any given day, the market's going to end up or down. 50-50. There's a slight advantage or skew to the upside, but on any given day, you can't discern that. There's just no way. So, but essentially, it is a 50-50 shot, even in a trending market. If you were to take a look at a long trend and count up all the days it ended up and ones that ended down, whether it's bullish or bearish, you'll find that it's still about a 50-50 shot. The difference, the main difference, this requires the big head here. The main difference is that those moves in the direction of the trend tend to be on average of greater magnitude. And so because we're putting on out of the money butterflies, we're looking to capture more of those moves. So if more of the moves are bigger in the direction of the trend, we want to trade in the direction of the trend, or however we figure that out. But still, with the full knowledge that on that day, on any given day, it could end up or down. Get it? So we get a slight edge by moving in the direction of the trend. Now, it gets even hairier, though, when the trend is not very noticeable, like it has been for the past couple of months. But that's just that's what we deal with. What do you do, right? We do our best. And we know that regardless of whether we choose an out-of-the-money put fly or an out-of-the-money call fly, that we still have an equal opportunity to make money that day. And on stronger markets, there's no doubt that it's a little bit easier. But you have your caveats there, too. If it's a strong bull market, volatility is coming down, and so we have to go lower in our widths, and there's less opportunity because of that low volatility and accelerated premium decay. When volatility is high, we have much more opportunity, and we go much wider and go for bigger trades. But still, the trend is the trend. So that's what we deal with, and that is part of our strategy. It is a long-term mathematical approach. It's why you've probably heard the cliche, trade with the trend is your friend, and it's exactly why. And that is because trading with the trend will put you in a position to grab those longer magnitudinal moves, or those larger magnitudinal moves in the direction of the trend. They are going to be bigger than the average move going counter trend. All right? So that's why we do it. And it's also why Your ultimate direction, particularly with an asymmetric trade like the out of the money butterfly, doesn't matter. You can still be wrong and be right at the same time. Get it? So that's and also we have to resign to the fact that we are, because it's a purely probabilistic coin flip game. We're 50-50 traders. We only get about a 50% win rate. But you might say, 50%, I'm working on 80%, 90%. Yeah, where's that getting you? I don't care about win rate. I only care about return on capital. That's it. Return on capital and the volatility of my returns is my ultimate arbiter. It is what tells me whether or not I'm doing the right job. And by all accounts, when you look at our performance, my performance, there's no arguing that doing the right thing, right? So I'm keeping my sanity. I'm putting on small risk. I'm never jarred by market moves. I can withstand really bad losing streaks. I love big winning streaks. They both happen. Can't force that. But I never take a big risk. I never am in trouble of a big drawdown ever. And if you'd like to trade that way, go down below. We have the 0 DTE Academy. I can show you how to totally transform. By the way, this is a professional way, a methodology of trading. All pros, I've been an institutional trader, fund manager, and I'm telling you, all pros are after the same two things. Small volatility of returns so that they can stay in the game. Large potential for profit, right? They know that the potential for profit doesn't mean that they're going for that every day. It's a probabilistic game. That means the market's going to deal you out what it wants to deal, when it wants to deal it, and you have to accept that timing. The big thing is stay in the game until those opportunities come and then seize them. And trading this way in terms of direction is all part of that game. We know what the edge is, and in the long run, that edge is going to pay off. That's the way it is. All right. Hope you got something out of that. And today, again, directional bias is super important, but it's only one of our edges. We have about 4 different edges that we're going after. We understand completely whether that edge is strong or weak, where it is, and how to adjust to it. And if you'd like to learn to trade that way, get out of the weeds. Don't feel like you're constantly, and can sleep at night. Give the 0 DTE Academy a shot. Link is down below. Did I say that already? All right. All right. Thank you very much. Coach Ernie, out.